Stocks ETF. A stocks ETF holds shares of publicly traded companies and tracks an index like the S&P 500 or a specific sector. It gives investors instant diversification across many companies in a single purchase. These are popular for long-term growth because they spread risk while keeping costs relatively low. Bond ETF. A bond ETF invests in government or corporate debt instead of company shares. It typically provides steadier income through interest payments and is often used to reduce portfolio volatility. Bond ETFs are common among investors seeking stability or regular cash flow. Index ETF. An index ETF tracks a specific market index, such as a broad national market or a global benchmark. Instead of trying to beat the market, it aims to match it. This passive approach usually results in lower fees and consistent long-term performance tied to the index. Sector ETF. A sector ETF focuses on a single industry like technology, healthcare, or energy. It allows investors to target areas they believe will grow faster than the overall market. Because it concentrates on one sector, it carries higher risk but also higher potential reward. Commodity ETF. A commodity ETF tracks the price of physical goods like gold, oil, or agricultural products. Some hold the actual commodity while others use futures contracts. Investors use them to hedge against inflation or diversify beyond stocks and bonds. Dividend ETF. A dividend ETF invests in companies known for paying regular dividends. These funds focus on steady income and often include established, financially stable firms. They are attractive to income-focused investors and retirees. Growth ETF. A growth ETF targets companies expected to grow earnings faster than the overall market. These firms often reinvest profits instead of paying dividends. Growth ETFs can offer strong returns but tend to be more volatile. Value ETF. A value ETF focuses on companies that appear undervalued based on financial metrics. These businesses may be temporarily overlooked by the market. Investors buy value ETFs expecting the market to eventually recognize the company's true worth. International ETF. An international ETF invests in companies outside an investor's home country. It provides exposure to foreign markets, spreading geographic risk. These ETFs can focus on developed markets, emerging markets, or specific regions. Inverse ETF. An inverse ETF is designed to move in the opposite direction of a specific index. When the market falls, this ETF rises. It is typically used for short-term hedging rather than long-term investing because of its structure and daily reset mechanism. Leveraged ETF. A leveraged ETF aims to amplify the daily returns of an index, often by 2 or 3 times. It uses financial derivatives to achieve this effect. While it can generate large gains in short periods, it also increases losses and is usually suited for experienced traders.